Hello and welcome to Chapter 14. So we just got done with Chapter 13 talking about stocks and how corporations can issue stocks to raise capital. Now we're going to talk about bonds, which is the other instrument that we can use for companies to actually go ahead and raise money. So we're going to talk about bond basics, bond issuances, retirement, and long-term notes. So bond basics begins on page 550, and really here's the thing we just talked about is bonds are debt that a company issues. So any company can issue debt. The thing is that you may not always find a buyer for that debt. So bonds are debt that is issued by a company. So if we look back, if you remember in chapter 13, we talked about ways to finance a business. So you finance it through sales or revenue. You raise it through owner investment, otherwise known as the owner capital account in chapter 12. Also, you can fund it by debt, which is this chapter, and you can also sell equity, which is stocks and which is basically stocks. So that is going ahead, and you can also sell equity, which is stocks. So that was chapter 13. The pros and cons are on page 550 and 551. Definitely encourage you to check those out. So whenever a bond is issued, it can be either sold at par, premium, or discount. And all of this depends on the market interest rate. And so remember, on a part of a bond, as you will learn in this chapter, is that you have to have a stated contract rate that says this is what the payment will be, because each bond pays out an interest payment and the par value at the end of the life. So basically, Exhibit 14.3 is a way to help you measure and see what is par, what is premium, what is discount. It all ties back to interest rate. So just remember that. Also, whenever bonds are issued, they are priced. And so this is basically looking at time value of money, which if you read it in Appendix B, I strongly encourage you, those of you who are going to go on and look at accounting or finance or who are thinking about running your own business, you really need to understand the time value of money. So it's a very, very good chapter to read. You'll use tables B1 and B3. And the thing that you're looking at when you're looking at tables B1 and B3 is that the rate that goes across the top is actually referencing back to the market interest rate. The period is actually talking about the total number of payments that are being made. So what you'll do is you'll look at the number of periods, payment periods during a year, and you'll figure out the market interest rate. I'll show you how to do that whenever you see examples of how to price a bond, because I'll do that using LiveScribe. Also, go ahead and review Exhibits 14.12 and 14.13 to get a better understanding of sort of how we're going to use those tables to price a bond. Most of the problems in this chapter are actually going to give you the sell price, so you won't need to actually have to calculate it, but you will have to know how to do this later on when we start looking at evaluating leases. So, retirement. The thing about retirement is this, is that every bond has some sort of maturation date or term date. What it is it reaches the point where the bond no longer is paying out, so therefore it's the termination area time frame. So what you'll do is you will pay out and give the person who lent you the money, you'll pay them back the full amount of par value, along with the last interest payment. So those are things you're looking at. Now, some bonds have different portions to them. So for instance, you can have a bond that just does a normal payout, which you pay out the full cash and that's it, and it's done with. Other bonds can go ahead and be used as conversions. You can actually go ahead and convert that bond to stock. This is very typical for startup companies who are receiving venture capital. What's going on is the venture capital, the investors are going ahead and borrowing, basically lending money to the owner of the company, and their percent equity is turned into a convertible bond. And so what happens then is that that bond can be turned into stock once the company goes public. So there's a couple different ways to do that. As always, bonds can also be bought back just like stock. They can be retired at any time as the issuer so defines. So if you had lots of cash, you may want to buy it, get rid of all your bonds to reduce your future liabilities. So bonds are a separate animal, but a lot of people, when they think of long-term debt, they really think of the long-term notes payable, which is really similar to a loan. And in fact, it is a loan. Really, the thing you need to keep in mind is Exhibit 1414 shows you how that works. Is really looking at it and saying that, remember, every payment that you make to a lender is typically going to be broken into two parts. There's going to be an interest payment and there will be a principal payment. The interest payment just simply pays off the interest that's accrued during that time frame. The principal payment is actually the amount you initially borrowed. So that's what happens is when you look at Exhibit 1414, you'll see there's lots of interest typically up front. It's very much front loaded. And then what happens is as you go through your contract, you start paying off more and more principal and less interest. And the reason being is that principal payment keeps decreasing every time you pay. So more things on bonds and notes is looking at the debt features. So look at page 563. It's really important. It shows you the different types of loans that are out there, different types of lending like secured lending, unsecured lending, convertible and callable bonds. So there's a lot of really excellent information in there that gives you the different ideas, gives you ideas about the different types of instruments that are out there that a company can go ahead and use. The last we want to look at is debt to equity ratio, which is on page 563 and 564. This is your ratio for this chapter, and it really looks at total debt divided by total equity. So that's something you're looking at. Is a lot of lenders use this formula. It's very, very important. The key to this is remember to only use the current year totals. So in 2010, you will only go ahead and use 2010 numbers. If you're looking at 2009, you only use the 2009 numbers. That's the key thing to keep in mind. Okay, well, that's it. I look forward to your questions, and we'll see you in class. Bye.